This video is intended to provide some additional information about business organizations. There are three traditional forms of doing business and several variations on those traditional forms of business. Each form of doing business has its own characteristics, and those characteristics determine which form of business is the best choice for businesses in different circumstances. The traditional forms of doing business are the sole proprietorship, the partnership, and the corporation, and some of the variations or hybrid forms of doing business are the limited partnership, the subchapter S corporation, and the limited liability company or LLC. Sole proprietorships are the simplest form of doing business because they require very little organization. Sometimes nothing more than a business license is required. And sole proprietorships involve only one owner. In a sole proprietorship, there is that one owner, the sole proprietor, and though the sole proprietor can hire employees to work in the business, the sole proprietor is the boss and has the sole right to make all of the business decisions. Legally, there is no distinction between the sole proprietorship business and the sole proprietor. And that fact results in two circumstances that are usually pretty good reasons that a sole proprietorship isn't the best choice for a particular business. First, all the profits from the sole proprietorship business are taxed to the sole proprietor. And second, all of the legal obligations of the sole proprietorship business are the legal obligations of the sole proprietor. That is, very few tax advantages are available to sole proprietorship businesses, and sole proprietors have unlimited liability for the legal obligations of the sole proprietorship business. A partnership is another traditional form of doing business, and it's the result of an agreement, which can be verbal or written, between two or more people or entities to carry on a business for profit. That means that the distinction between sole proprietorships and partnerships include that partnerships require more organization than sole proprietorships, and partnerships involve at least two owners. The liability for the legal obligations of the partnership is called joint and several liability. That means that each partner is completely liable personally for the legal obligations of the partnership, no matter what their ownership interest in the partnership is. Another characteristic of the partnership is that the partnership itself does not pay taxes on its profit, but each of the partners in the partnership is responsible for paying the taxes due on their portion of the partnership income. Corporations are very different from sole proprietorships and partnerships. First, corporations must be formed according to the laws of the state where the corporation is located, which means that at least forms must be filed with and information about the corporation and the owners of the corporation disclosed to the state where the corporation is formed. Another difference between corporations and other forms of doing business is that the owners of a corporation, who are called stockholders or shareholders, have limited liability for the legal obligations of the corporation. Limited liability means that stockholders are not personally liable for the legal obligations of the corporation, but if the corporation is not able to pay its legal obligations, then the stockholders' interest, the value of the stockholders' interest in the corporation may decline even to the point where the stockholders' interest in the corporation becomes worthless. Another difference between corporations and other forms of doing business is that a corporation is a separate legal entity, separate from the owners of the corporation. So corporations are responsible for paying the taxes due on the profits made by the corporation. That characteristic of corporations gives rise to something called double taxation, which is a reason that a corporation may not be the best choice for conducting certain kinds of businesses. Double taxation occurs because the profits of a corporation are distributed to stockholders in the form of dividends, which is an amount of money paid by the corporation to stockholders in the corporation on the basis of the number of shares of stock they own in that corporation. Well, the dividends paid by a corporation to stockholders are not deductible expenses of a corporation in determining the taxable income of the corporation. So essentially, dividends paid by a corporation to its stockholders are paid from money that the corporation has after it's paid its taxes, its income taxes. Then, when a stockholder receives a dividend from a corporation, that dividend is taxable income to the stockholder. The stockholder has to pay taxes on the amount of dividends received from the corporation. The result is that the money that the corporation pays as a dividend has been taxed twice, once at the corporate level and once at the stockholder level, thus giving rise to the double taxation characteristic of corporate dividends. In addition to these three traditional forms of doing business, there are also limited partnerships. Remember that one of the negatives of a partnership form of doing business is that the partners, the owners, have unlimited liability for the legal obligations of the partnership. Well, limited liabilities partially address that issue because limited partnerships have two categories of partners, general partners and limited partners. The general partner is involved in the operation of the partnership business and must have unlimited liability for the partnership legal obligations. But limited partners don't have legal liability for the obligations of the partnership, but they cannot be involved in the management of the partnership business. Another hybrid form of doing business is the Subchapter S corporation, called Subchapter S because it is authorized by Subchapter S of the Internal Revenue Code. Subchapter S corporations are taxed like partnerships are taxed, thus avoiding the double taxation of corporate dividends issue. But a corporation must meet certain requirements under Subchapter S, which limit the size of the corporation and place restrictions on the operations of the corporation. And finally, a form of business that is relatively new, developed in the last 40 years or so, is the limited liability company, or LLC, which offers the limited liability of a corporation to its owners with the tax advantages of being taxed like a partnership and avoiding the double taxation of corporate dividends without the restrictions imposed by the Subchapter S of the Internal Revenue Code.